In this lecture, I am going to teach you how to deal with lease contract under the lessee account. So let's get started. The first things we are going to look at the recognition, how the lessee recognize its lease contract. At the commencement date, the lessee recognizes the right of use an asset and the lease liability in its financial statement. So when the contract is started, at the commencement date, the lessee should recognize the right of use an asset, which is underlined asset, and the lease liability. So the right of use asset is the underlying asset that made available by lessor to lessee for use during the lease term. So the right of use asset includes the following amounts. Lessee should recognize the present value of lease payments not paid at the commencement date. So the lessee write down the present value of lease payments not paid at the commencement date. We will look at the practical example. How do we calculate the present value of lease payment? And also the lessee recognize any lease payment made before or after the commencement date less any incentive received. So the lessee write down or include in the right of use an asset any lease payment made before or after. Let's say if the lessor gives 2 months from the total contract, 2 months free of charge, that would be the incentive and should be excluded from the lease, from the use of one asset, underlying asset. And C, we have any initial direct costs incurred by lessee. If the lessee pays any initial direct costs such as legal charge, arrangement for the lease contract, all those things should be included as underlying asset. Lastly, we have any estimate of any cost incurred by lessee in dismantling and removing the underlying asset or restoring the site on which he is located. So if we are as a lessee and have the obligation to restore or dismantle the underlying asset and deliver it to the lessor place or location at the end of the lease terms, we need to make the estimate amount, and this amount should be part of the underlying asset. On the other hand, we have the lease liability. So the lease liability is initially measured at the present value of lease payment not paid at the commencement date. This equals the right of use assets. So the lease liability is the amount that we should pay against using the underlying asset. So we have the obligation. The lease liability is discounted at the interest rate implicit in the lease. So in order for us to account the lease liability, we should use the interest rate that's implicit in the lease. The interest implicit should be the total present value of the lease payment and the unguaranteed residual value to be equal to the sum of these two. Should be equal to the fair value of underlying asset and any initial direct cost. Practically speaking, the lessor does not share its interest rate with the lessee, and that's why it is very difficult to find the interest rate implicit in the contract. And that's why in practical, the lessee should use the incremental borrowing rate. It is very easy for the lessee to find the incremental borrowing rate. For example, if you go to the bank and you need to buy a new car, so they will tell you, if you are going to buy this car over 5 years, we will charge you 5% at the interest rate. So this is called incremental borrowing rate. So the lessee should use this rate to calculate the lease liability, as long as the lessor will not share the interest rate. So the lease liability includes fixed lease payments less any incentive received. Fixed lease payment, the amount of money that the lessee is going to pay yearly or monthly to the lessor as sort of using underlying asset. And we need to exclude or remove any amount, any incentive received. So, and then amount expected to be payable under residual value. And we have variables lease payments depending on index or rate, and purchase option. To give you the clear picture on right of use an asset and lease liability, the right of use an asset, the lessee should recognize right of use an asset in its financial statements as well as lease liability. So this lease right of use assets, it's going to be depreciated over its useful life or over the lease terms, which one is shorter. So the depreciation, the right of use an asset is subsequently depreciated. The depreciation should be over the shorter of the useful life of the underlying asset and the lease term, unless the title to the asset transferred at the end of the lease term, in which case depreciation is over the useful life. What does mean? The underlying asset should be depreciated either over its useful life or over the lease term. Let's take example. We are going to enter the lease contract over 5 years. However, the economic useful life of the asset is 10 years. 5 years is lease term and the 10 years is useful life of assets. In this case, we are going to use 5 years, or we are going to depreciate these assets over 5 years because the lease term is shorter than economic useful life of assets. However, if in the contract clearly mentioned that the asset or the underlying asset would be transferred to the lessee at the end of the lease contract, we will depreciate the asset over its useful life. How to determine short-term or low-value leases? So IFRS 16 stated that the lessee should determine whether the lease contract is short-term or low-value leases. Short-term lease is the lease that at the commencement date has a term of 12 months or less. It means if our contract period is for 12 months or less than 12 months, this is called short-term lease. However, a lease cannot be qualified for the short-term asset if and only if contains purchase option, even though the contract is for the period of 12 months or less than 12 months, if and only if contain the purchase option. It means if we are going to buy these assets at the end of the lease, we are not going to consider or classify the asset as short-term lease. On the other hand, the assessment whether an underlying asset is a low value asset depends on certain circumstances, such as the lessee can benefit from the use of underlying assets on its own or together with other resources that are readily available. IFRS does not offer the specific elements of the assets as low value. However, computers and office furniture can be considered as low value assets. The accounting treatment for the short-term lease and low value asset is to be expensed out in profit, is to be charged out straightly in profit or loss. Same approach as operating lease under IAS 17. So if these two conditions are met, whether the lease term is 12 months or less, but does not contain the purchase option, we are no longer going to recognize right of use an asset or the liability. So just the lessee straight away to the profit or loss and expense out at the same approach with the IAS operating lease under IAS 17.